Joining me on the line today is Ellen Brown. Ellen is an attorney, financial researcher, and author of an excellent book entitled Web of Debt, The Shocking Truth About Our Money System and How We Can Break Free. Ellen, thank you so much for joining me today on Follow the Money Weekly.
Thanks, Jerry.
Ellen, I have a quote here from John Adams that says, "All the perplexities, confusions, distresses in America arise not from the defects in their Constitution or Confederation, not from a want of honor or virtue, so much as from downright ignorance of the nature of coin, credit, and circulation." Most Americans are, I would say, woefully uninformed on how money really works. And you talk about in your book the shocking truth about America's monetary system. What is the shocking truth about America's monetary system that you describe in your book?
The shocking truth is that there is no money in our money system. It's all debt. It's all created as debt to private banks. A credit system is actually not a bad thing. I mean, I think it's essential to have credit, but the problem is that this credit or debt is made to appear to be a loan of existing money of the bank itself or of the depositors of the bank, and it is neither. This money is actually created fresh every time you take out a loan, and that loan money becomes the money supply, the money that circulates in the economy. The only money that isn't created as a debt would be coins, but today that composes only 1/10,000th of the M3, the largest measure of the money supply. So it's almost nothing. They're tokens merely. All of the rest, including Federal Reserve notes, come into the money supply as a debt because we have to borrow the Federal Reserve notes. They're printed by the Federal Reserve. Well, they're printed by the Bureau of Engraving and Printing at the behest of the Federal Reserve, which is the customer. So the Federal Reserve gets them for something like 6 cents a bill, even if it's a $100 note. And then it lends those bills to the banks that need them to meet the demands of their customers. And then they go out into the systems, so and including getting lent to the U.S. government. So the government gets its own national money by borrowing it. It doesn't actually issue the money except for coins.
So every dollar bill in our pockets, it's actually debt that we're carrying, not actually money. Is that what you're saying?
Well, it originates as a debt. For you, it's real money. I mean, for somebody who gets paid a salary, he got paid $1 for a dollar's work. So there's no debt owed between him and his boss. But somewhere along the line, where that money came into existence was as a debt to a bank. So that allows the banks to funnel and control our money, and they determine who can create credit and who gets credit, which is an arbitrary control or limit on what we can actually create. If we had a public money, I mean, if we acknowledge that all money is simply a series of legal agreements, it's merely the monetization of your own promise to pay or a legal agreement to pay back over time. You're basically saying to the community, it's the full faith and credit of the United States. That's what we're lending here. There's no gold behind it. There's nothing behind it except the credit of the people. So if you say to the people, trust me to pay this advance back, advance me $100,000 and I will use it to pay for workers and materials and I will build this thing according to my business plan here, and the products will be sold and will pay back the loan with interest. If you acknowledge that that's what credit is, you could have a lot more credit. Credit could be much more fair. There wouldn't be the periodic waves of credit contraction and depression that have nothing to do with the productivity of the people that we have now.
Ellen, you know that America's banking system is in total disarray. We have a report out just recently that the FDIC is insuring $13.2 trillion in bank deposits with a negative $15.2 billion deposit insurance fund. So they're basically bankrupt. And out of the nearly 8,000 banking institutions, just 19 hold 50% of all the banking assets in the system. So it's a very bizarre system in disarray. Your book, Web of Debt, you've written extensively about the ills of the private banking system that you're describing. Talk to our audience about some of the problems posed by our current private banking system.
The FDIC system was set up in the Great Depression of the 1930s in order to protect the deposits of depositors. But today, the limit was 125,000, and now it's, I think that's right, and now it's 250,000. But there are many investors, like the big institutional investors, that have millions of dollars that they would deposit. So actually, I was reading lately, it was quite interesting that what went wrong with this recent collapse, every single banking collapse we've had for 300 years has resulted from a run on the banks. Well, this one didn't look like a run on the banks because you didn't see people standing outside in line trying to get their money out. But it was a run on the banks in the sense it was a run on the shadow banking system. So you mentioned $13 trillion that is insured by FDIC insurance, supposedly, and there's not even enough money for that. But there was this other banking system called the shadow banking system, which was $14 trillion. It was more than that, bigger than the regular banking system, and that's where the big institutional investors park their money because they aren't insured by FDIC insurance. So that the shadow banking system was where it was the repo market, where you take your mortgage-backed securities. The bank would put up mortgage-backed securities, and the investors would put up money for the day. So it's like a one-day repo. You can get this money back overnight. So it's essentially the same as deposits. It's very liquid. You can get your money out. But the trouble is, when everybody took their money out at once, when they realized these mortgage-backed securities weren't the AAA things that they had been represented to be, that was when the whole system collapsed. So essentially, what's wrong with the whole system and where it has gone down in every single case is that you have a run on the banks because the banks are pretending to have more money than they have. And when everybody figures out that they don't have the money, they all come rushing to the bank at once to get their money out. There's not enough money. The banks close their doors and the system collapses. So to fix that, you need a complete overhaul of our understanding of what money is. Instead of being a debt, it should be a credit, the credit of the people in a system that can't collapse, because you're just talking about legal agreements here. But that's beyond your question.
And you just wrote a recent article, Helicopter Ben needs to do a money drop over Main Street. I found it very interesting. You were talking about how the printing press appears to be getting ready to be turned back on because of the new quantitative easing that's being bantered about, so QE2, so to speak. You make a really interesting comment that really struck me as I was reading the article. You state, and I'm quoting you, the fact that swapping dollars for debt has not created inflation so far suggests that the government could actually print its way out of the federal debt, I'm assuming you're talking about the national debt, without the dreaded hyperinflation long warned of by its pundits. Now, the reason that I found that interesting was because the national debt is made up of bondholders, from around the world for that matter. But whenever if they were actually to print money and then pay off all of those bonds, that would obviously inject all that freshly printed money out into the global financial system. But you say that would actually possibly not create the dreaded hyperinflation that's long warned of by pundits. Explain that. That's a very interesting comment that you make.
Well, the thing is that the bonds themselves trade just as if they were money, and that's why quantitative easing hasn't worked. What the Fed has done is to swap bonds held by banks for $1. So they printed a bunch of dollars. Originally, they printed $1.25 trillion. They didn't print them, of course. It was all electronic. In fact, there was a recent NPR segment. I don't know if you heard. It was really interesting about these people that were hired to buy $1.25 trillion in mortgage-backed securities very quickly. So they were just they'd decide they wanted to buy one, and then they'd just push a button, and it would be paid for. So it was just paid for electronically with this by computer. The computer spit out the money to pay for the mortgage-backed security. So they put $1.25 trillion onto the balance sheets of the banks. In other words, into the reserves, with the idea that the banks would then leverage that into 10 times that sum in loans, the way banks do. But in fact, nothing happens. No leverage happened, because whether the banks had the bonds or the dollars, they could have made the loans. Anyway, the bonds and the dollars served the same purpose. So the bonds around the world are traded just like money. They're held on the books of banks in order to protect their currency. Well, if you, the central banks, well, if you cashed out those bonds, they'd still hold them on their books. In fact, they hold a lot of cash on their books in order to protect their currencies. They still want that cash sitting there in whatever form to prevent speculators from coming in and devaluing their currency by short selling. They have something to cover with. So the argument would be you haven't actually changed the amount of money out there by swapping dollars for the bonds that are sitting on the books of the banks. When they make loans, what limits the amount of loans that banks make today is the capital requirement, which is something totally different from the reserve requirement. The capital requirement is actual equity. It's actual cash that the banks have to have of their own. And the fact that they can borrow more reserves, I don't think you're allowed to borrow your Tier 1 capital for your capital requirement. It has to be money that you raised by selling stock or that you got from interest for your loans. So what actually limits lending today is a lack of capital and lack of creditworthy borrowers. It used to be that they didn't worry about creditworthiness. They lent to anybody in sight because they knew they were going to sell them off to these investors, and the investors would have to deal with the risk, which they did with derivatives. Supposedly it was all protected by derivatives. So they'd sell to anybody, so anybody who walked in the door who wanted a loan could get one, and so that's why the money supply expanded so much. But now they can't make those loans, so they have to have really good borrowers, either businesses. They don't want to lend to businesses that could be risky, and they don't want to lend to homeowners that could be risky when they're getting this money for almost nothing at the Fed funds rate of 0.2%, or I think it's even lower than that now. And they can turn around and buy long-term government bonds for 2 or 3%, and take no risk at all. So why should they take a risk?
That's a great
point. They already have messed up balance sheets. Their capital is already limited, so they don't want to be making extra loans that could cut into their capital base anymore.